CEO of Berkshire Hathaway, Warren Buffett. Given his return of over 3 million% since he took control of the floundering textile manufacturer, in 1965, he is widely considered one of the world's most successful investors. And interestingly, he has taken the time to write an update letter to Berkshire Hathaway shareholders every year since 1965. This letter has become a highly anticipated document among Berkshire Hathaway shareholders, investors, and business leaders. Welcome to Financial Fortune. Don't forget to subscribe to the channel and hit the thumbs up button. Warren isn't interested in writing shareholder letters to promote the company to potential investors for the same reason that many other CEOs do. Instead, he uses the Berkshire Hathaway shareholder letters as a platform to share his insights into investing strategy, thoughts on the economy, and updates on the companies in which he has a stake.
Berkshire Hathaway Chairman and CEO Warren Buffett joining us just after writing his annual letter to shareholders. And Warren, this is a big deal. It's something that the investment community kind of waits on and sees as a must read because you spend so much time actually writing this yourself.
Yeah, too much.
When do you start writing the letter?
Well, this one I started very early because I had one section in mind. It turned out to be the last section. But when I talk about the American tailwind, I probably wrote that in late summer, and then I work around different sections, but it takes a long time. Yeah, I am not a first draft writer.
Well, for people who have been reading this for a long time, this letter was markedly different than you've written for the past 3 decades or so, because at the top, the opening of every letter in the past to this point has been Berkshire's percentage change in book value as the measure that you thought was most important. This time, you kind of stripped it out and said it's not the most important metric anymore for a couple of reasons. One is which Berkshire has changed so markedly, but also you just think it's not going to be the way that you'll be measuring things in the future.
No, it's not the more relevant figure, at least over time, not in any 1 year period, but basically it's market value, because we have become overwhelmingly an operating company, and we hope to become even more so than a company that really held a lot of stocks and bonds. I've actually talked about that in previous reports. I wouldn't have wanted to quit in a year where I got clobbered by the one I was dropping and was adopting one that made me look good. So I actually included them both in, and it was a good year to make the transition. And you said it's different. I've always had the image that I am talking to my sisters. I have 2 sisters. They're both Berkshire's, pretty much their whole investment. They're smart. They're not active in business, so they're not reading about it every day. But I pretend they've been away for a year, and I'm reporting to them on their investment. And then this year, because we may be repurchasing shares, I tried to have the vision that they were talking to me about whether they should sell their shares, and I was explaining to them exactly how I would look at it if I were in their shoes. So it's Dear Doris and Bertie at the start, and then I take that off at the end. But I'm talking to them, and I'm trying to talk to them in a manner where if they're practically entirely in Berkshire, and if they were thinking of selling some, here's what I'd want them to know before they made a decision.
All right, Warren Buffett publishing his annual letter to Berkshire Hathaway shareholders this weekend. In his latest entry into the 60-plus-year tradition, the so-called Oracle of Omaha preaching the merits of reinvestment, writing, quote, "The power of compounding your money inside a successful business for a long time is nearly unmatched in capitalism." Joining us now to discuss a little bit more about that and also what else we heard from Buffett over the week, I want to bring in Bill Smead, Smead Capital Management Chief Investment Officer. Bill, it's great to see you again. So certainly no shortage of lines that we could pick out here from the shareholder letter over the weekend. Share buybacks, taxes, earnings, long-term optimism here on the U.S. economy, just to name a few. Just first, your takeaway from the shareholder letter that we just got.
Well, we thought it was a great letter. And one of the things was he said, he makes an incredibly important decision on average once every 5 years. In a 60-year stretch, he came up with about 12 investments that made all the difference for him. which you compare that to what most people do and what most of your watchers and most of the behavior of investors in the United States, and they change their stocks about as often as they change their clothes.
Bill, great to see you here today. And you and I have talked about this at webinars generally surrounding Warren Buffett's releases of the annual shareholder letter in years past. And if we're on this schedule, let's see, a dozen good business ideas once every 60 years, or every 60 years, that's about one great idea once every 5 years. Do they still have it? Munger and Buffett, are they still executing?
Yeah, the reason for that is they got very large, and that limited what they could do, right? They have to do things in a very, very large way. When in the first 25 years Buffett was picking stocks, he had a huge information advantage over everyone else, and the education he got from Ben Graham, who was an excellent buyer of 50-cent dollars. So what Munger helped him realize in See's Candy and brands is that as you manage very, very large amounts of capital, you're going to be limited in the number of good ideas that are available to you. If Buffett was running $10 billion, he could have just gone out in the spring of 2020 and had a Ben Graham delight session. But instead, he had $120 billion and has looked for things like Oxy and Chevron to put it in based on their view of the next 10 years.
And Bill, you and I have also talked about some of the secular tailwinds benefiting certain industries. You take a look at millennials, and with the continued demand we expect them to have for housing over the next decade, you can tie oil into some secular themes. They're just wondering how you're seeing Buffett play out in the 2020s and his style of investing here.
That's a great question. Buffett mentioned that you need to be a lifelong learner, and when things change, you need to learn and adapt with it. And what he figured out was the railroad industry was going to be dramatically more attractive to him when it was only 4 companies, including the company that he bought, Burlington Northern Santa Fe. We feel that same way about the 3 home builders that we own. That industry has changed dramatically. It used to be a land development business where you put a house on it to turn the lots over, right, to gain the profit out of the lot. Now, in the case of Horton, Lennar, and NVR, the vast majority of the land they build on is developed by someone else, and they're just a home manufacturer. So we find that business incredibly attractive because there's 92 million millennials coming, and now that people have gotten off of their big city, single, expensive apartment routine in the major coastal cities and are spreading themselves out across the country, there's an awful lot of homes to be built.
I appreciate you checking out the video, and I hope you enjoyed it. If so, please hit that like button, and I'll see you in the next one.